Hello and welcome to GoodGood Investing. I'm Rachel Grunn.
I'm Andrea Cwik.
And we are so happy to be back for another week of good investing. It's been a minute since we've been together in studio, so I'm happy to see you. I'm going to move your mic a little closer.
You left me for the longest time. I think it was like 9 days. I was counting down.
Yeah.
I made a little chain, those paper chains. And every time you were gone, I would break the little paper and put it in the garbage. And I'm like, 8 more days.
Oh, that's hilarious. I love that. Yes, so I did. I went to Disney without my baby, which I highly recommend to anyone who wants to go to Disney. Don't do it unless your kid's like at least 5 years old. So just leave them at home with grandma and grandpa. That's what we did. And we had a fantastic time. It was so fun. It was really great.
I mean, to be honest, I probably would have been like 48 hours and then desperately coming back home. But I love that you're so free and you're
that's awesome.
You had a great time. That is so awesome. I need to do a little bit more of that self-care type trips, which I'm going to Mexico for a few days to celebrate my cousin's anniversary, 25th anniversary. And I'm going on my own and meeting my family from California over there. So that's exciting. I've never done that before.
That'd be so fun.
I know.
Go on a little jaunt to Mexico. So I did go to Florida for a week, and you know what else is in Florida?
Disney World.
That's where I went. Yes. What else is in Florida are some fantastic multifamily investments.
Yes, ours specifically. We have two.
Yeah. We currently have two that we own there in Florida. And today we're kind of going to be talking about where in the U.S. you should invest, right?
Yes.
As a passive investor, you still have to do baseline levels of due diligence to make sure that the market is a good market for your investment. And so we're going to break it down because the different asset classes also mean that it's Tux. He's so funny.
Tux is making his GoodGood Investing debut. So for those of you that are not on our YouTube channel, you can see my dog Tux.
Yes. You can head over to YouTube and see cute little Tuxie. So depending on the asset class that you are invested in, some states are better than others.
Yeah.
So it's something to think about for sure. So we'll kind of start, I guess, with multifamily since that's what we're working in the most right now.
Yeah.
So what would be some good places to invest in multifamily?
Okay, so I think the way to think about it before we give you a list of cities is really to think about it in a few different categories. So like one is we always look for states that are landlord friendly. So if you take a map, you can look at, okay, which ones are red states, blue states. It is kind of separated like that where more red states are landlord friendly. So we see it more like in the Sun Belt area. There's a lot of opportunities in those states to invest and, make the asset add value to it. And then if there is, we never want to displace anybody, right? Like we don't want to displace our renters. We're adding value, so we have to increase rent to support those remodels. But if they can't pay, then we want to be able to legally be able to take the steps necessary to help them place in a different location where they can afford to pay the rent, right? Yeah. So that's one.
Yeah.
What else?
Well, I mean, you're also looking at, you don't want to invest in a one-horse town either. So a town that only has one industry. A huge example of that would probably be Memphis. I know our partners have invested in Memphis before because they have a lot of fantastic tax advantages that actually made their multifamily investments perform super well. But the deal with Memphis is you have FedEx, and that's it.
Yeah.
FedEx, that's the FedEx hub is in Memphis, but not much. So what if one day FedEx got a really good incentive from, say, like Tallahassee, okay? And we're going to move to Tallahassee because they're going to, mitigate our tax liability. Well, then Memphis suddenly has no industry. So you don't want to invest in a town where the entire like economic ecosystem is dependent on one large retailer or one large company.
Yeah.
I think that's really important.
Oh, and that leads me to think about the other thing that's very important is that you look at history to see if people are moving there. Like, are there growth patterns? So you want to pick a location where there's people moving. Right now on the West Coast, people are leaving. So there's a lot of people going to the Sunbelt states. That's perfect for investing in the Sunbelt, right? So definitely look at population patterns. And then the other thing I would look at is, like you said, the industry, making sure that there's multiple large businesses, but also, is there hospitals? Is there an airport? And then I would also look at crime. Crime is a huge one. So when you're investing, look at the crime in the state, look at even in the neighborhood, look at salaries. I want you to be like really informed on where you decide to invest. So these are things that we also look at.
Yeah, and that's not to say that the sponsor that you choose to invest with isn't doing that in due diligence. They should be. That's like very basic due diligence. Before you even underwrite a deal, you should know all that stuff.
Yeah.
But you trust but verify, right? So I think it's really important that you're convicted and excited about your investment. So doing that own due diligence for yourself would be really helpful. Now that's with multifamily. And depending on the investment, you might be looking at different markets. So let's talk about triple net for a minute. Triple net is like retail centers, like buying up. Triple net is basically, we did an episode on it a ways back, but essentially it's a type of lease where the tenant pays not only the rent, but also taxes, insurance, and maintenance. So it leaves very little overhead or liability, not liability, I would say like financial responsibility for the owner. So they're not having to pay taxes, insurance, or maintenance on the property. And then they also have a tenant that's paying rent. Now with these, the tenants usually sign like anywhere between 5 to 10 year leases. So the opportunity to escalate rent is small. Lots of triple net leases have an escalation clause where like after year 5, it'll go up X%. But again, if the market booms, you don't really have an ability to kick that tenant out and up the rent. So it's like a blue chip stock, I'd say. It's just easy breezy, like maybe not a huge appreciation upside, kind of just a cash flow play. But with triple net, if you're buying up Walgreens and
Starbucks.
Yeah, all that.
You're buying the shell of the building,
yes,
basically.
Correct.
And then you're getting one of those big companies to use that piece of real estate for their purposes.
Yeah. And that you can invest anywhere. You can invest in California, you can invest in New York, which are not places you want to touch in multifamily, but because it's not the same business plan and management as a multifamily building, you're able to invest in states that aren't landlord friendly because you're dealing with companies, not tenants. You're not dealing with like people and families. You're dealing with companies, and generally their leases are guaranteed corporately. So if Dollar General in Waxahachie, Texas can't pay their rent for that month and didn't make enough money, Dollar General America comes in and guarantees that rent. So
I would say, though, I think for due diligence on triple N, you still want to make sure that maybe wherever they're placing, wherever that asset is that you're thinking about buying, that there is population to support the business.
And traffic, yeah.
Yeah. Because I wonder, like in rural Tyler, where there's not even a Starbucks unless like it's 30 minutes away. If they decided to put a Starbucks there, how good would it be? I mean, I think it would be good. But.
It would be good. But also like Dollar Generals, you could literally put in the middle of nowhere and they will do so well.
Yeah.
Especially if there's not like a Walmart within like 20 miles. Like, oh my gosh, it'd be a killer deal. So again, totally different. Car washes, similarly, you're probably going to be looking at more like weather patterns and stuff like that.
Right.
And of course, like, people with higher incomes, because generally people with, nicer cars go to the car wash more often, right?
Yeah.
And then also, is it a super rainy town? Does it never rain? Like those types of things might affect a car wash investment. So those are just very interesting things, I think, to kind of think about whenever you're looking at what you should invest in.
Yeah, I love it.
And where you should invest.
Yeah. Absolutely.
I mean, I love Dallas. I feel like Dallas ticks all the boxes for all those investments.
There's car washes. There's triple and multifamily.
And multifamily and oil and gas.
Yeah.
Like Dallas especially is booming. I mean,
yeah.
I was at a conference last weekend, and it was actually real estate guys were there talking, and he was like, live where you want to live and invest where you should invest. You don't need to invest where you live. And I think that's what separates commercial real estate from residential real estate is that residential real estate, you kind of got to invest where you live. I know some people that do it remotely, but that's hard, you know?
Right,
so
right.
It unlocks the ability for you to live wherever you want and invest wherever you want.
Yeah, and I think that it opens the doors up too. When you have that mindset, then it opens up the door for more freedom, because my California friends might not be able to buy things in California because they're already paying for their large mortgage.
Yes.
Right? And so then they're like, oh, cool. Maybe I can look at some Sunbelt states to buy a rental, a duplex, or, invest with us, where we help diversify our investors' funds into multiple projects across multiple states.
Yep, exactly. Diversification is key.
Mm-hmm.
Well, guys, that summarizes that, and we have some exciting content coming out in the next couple of weeks. And I know we already plugged it in a little commercial, but we do have a 3-in-1 net worth assessment tool you can find on our website, GoodGoodInvesting.com. Connect with us, get to know us. We always have exciting virtual and in-person events going on, and getting onto our email list will assure that you get those notifications, but connecting with us on a call will make sure that you get our investment notifications. So, anything to add?
No, I think we covered it all.
Great.
But as always, if you have questions, send us an email and we'd be glad to respond to it. Also, if you love our podcast, we hope that you do. We ask you to review it. Of course, give it, how many stars can you give it? 10?
5?
20? 50 stars?
But just try for 6. We'll see what happens. You put that in the caption. Try to give it 6 stars. Apple wouldn't let me. But yeah, it would
give
mean
the
so
maximum number of stars.
The maximum number.
Yeah, it would mean so much to us, and we so appreciate our listeners, and we're here to help you with whatever you need. So
love it. Well, don't invest good, Andrea.
Invest twice as good. Bye.